How does pin risk work? Have you ever wondered what happens when an option's strike price is just a whisper away from the underlying asset's price at expiration? This situation is known as pin risk, and it can create a lot of uncertainty for traders. Let's break it down. Pin risk occurs when the price of the underlying stock or asset is very close to the option's strike price on the expiration date. Imagine a stock closing at $50 when you have options with a $50 strike price. That is what we call pinning the strike. Now, this scenario leads to some tough decisions for both option holders and option sellers. For option holders, if their option is at the money or just slightly in the money, they must decide whether to exercise it. This can be tricky because if they do not exercise, they might miss out on potential profits. On the flip side, if they exercise and the stock price moves against them after hours, they could face losses. Option sellers also face challenges. If the stock closes just out of the money, the option expires worthless, allowing sellers to keep the premium they received. However, if it closes just in the money, they may be assigned and have to buy or sell the underlying stock at the strike price. This can lead to unfavorable positions if the stock price moves against them before they can adjust their exposure. One of the biggest issues with pin risk is that the final decisions about assignment or exercise often happen after the market closes on expiration day. The underlying stock does not trade until the next market session. This delay means traders are at risk of significant price gaps overnight or over the weekend, which can lead to unexpected financial outcomes. Pin risk can also complicate more complex trading strategies like iron condors, where multiple strikes are involved. When a strike pins, traders may not know which legs of their spread will be assigned until after expiration. This uncertainty can leave them with unexpected naked short positions or unhedged exposure. To manage pin risk effectively, traders often keep an eye on open interest at specific strike prices. This helps them gauge where pinning is likely to occur. Many traders also choose to close or adjust their positions before expiration to avoid the uncertainty of assignment. Understanding pin risk is essential for preparing for possible overnight price gaps and avoiding surprises in their portfolios after expiration. In essence, pin risk is all about the uncertainty surrounding exercise and assignment when the underlying asset's price is very close to an option's strike price at expiration. It can lead to unexpected positions and financial exposure due to price movements occurring after the market closes but before the next trading session begins.